So what happened in 2008? Let's take a look. This article explains the money flows and the problems it creates for emerging markets. Hot money flows in during good times and motivates local instincts. Asset prices go up, but when the hot money goes out, it becomes painful. But rest assured, these economies are definitely in growth mode. Growth rates may ebb and flow, but even a 7% growth rate is fantastic by any standards. A large part of the developing world is expected to be the engines of growth for the global economy for the foreseeable future. So these markets do offer very good opportunities. As you can see from this graphic, most emerging markets took a beating, some larger than developed markets. But look at the rebounds in 2009. This is when these markets try to get back to their fair value after taking a drubbing. Unfortunately, most of these markets are still a decade away from having domestic institutional support and economies of scale where they can independently function well during stressful times in other parts of the world. So this kind of volatility is here to stay for now in these markets. The next two graphics shows the strength of financial investments and relationships between different regions of the world. This chart is for 1999. You can see that the US-Europe and the US-Japan have the strongest cross-border investment relationships. Asia, not including Japan, has small ties to all parts of the world, and all relationships with Russia, Eastern Europe, Latin America and Africa are tiny. It's quite evident that the center of gravity of financial strength lies on the left side of the chart with the US and Europe. Now let's fast forward to 2009. Now that's quite a different beast there. The US-Japan relationship has been overshadowed by many others. Asia has grown in size and the relationships with the rest of the world. Russia and Eastern Europe, Africa and Latin America have become much stronger.